most African countries have infrastructure shortfalls. Most African countries experience bouts of high inflation. Most African countries experience currency devaluation. How do we manage this? One of the things we do is that we find the kind of deals that allow us sufficient returns to be able to absorb the risk of currency devaluation. We take a country and we look at its track record. For example, we take Nigeria and we look at the fact that there has been an average um, rate of devaluation at 10% per year over the past 20 years, averagely, plus or minus. And so when we are structuring a project, we look for a project that will be able to absorb a rate of 10% devaluation every year and still remain profitable to the investors in the long term. That's one thing we do. So this means we have to find projects that have a relatively low entry point, or that's one thing that we do. The next thing that we do is we try to ensure that our deals have a long term. That is, when you invest for the long term, 5 years, 6 years, 7 years, there is room to be able to compound your growth inside the country where you are growing. There is that room. So we look for partners who have a long term view. Currency devaluations are usually very impactful in the short term, but in the long term, the local currencies or the local business has enough time to recover and grow and overtake the rate of devaluation. If you also look at the devaluation, the trend of devaluation in some of these countries, you will see that it's not necessarily consistent. There are sudden drops and spikes. So this also tells you why a long-term view is necessary. So if a spike, so for example, again, I'm using the Nigeria example. In the last few months, there's been a spike of devaluation. So if you invested in April and you wanted to be out by December, you will be hit by the devaluation. But if you invested in April 2023 and you were looking to be out by April 2030, you would face the spike of devaluation and then things will stabilize for a period and you would earn returns and compound your returns such that when you're leaving in 2023, in 2030, you will find out that you have um, earned more income or more returns than the rate of devaluation. The other thing we also try to do is to ensure that we find deals that give us the opportunity for high growth. Africa is a developing region, emerging markets and developing regions, which means there is a high demand. There is a place, for example, where we bought plots of land somewhere like 15 years ago or thereabouts. At that time, the plots of land in that place were probably about an equivalent of maybe $100 per plot to $300 per plot. Those same plots of land today have prices that range from $3,000 to $5,000 per plot, simply because there is far more people looking for homes than there is available homes. So you have this, relative to other regions, astronomical rates of growth, which when balanced out against rates of devaluation, currency devaluation, um, still offer a higher return on investment than other regions. Now, it's very important for me to state here that we don't offer people we don't promise people astounding returns. I'm just giving that as an example. We try to make our plans based on reasonable markets benchmarked returns. We're not a Ponzi scheme or any of these kind of things, giving people unusual promises. We make reasonable projections. If we beat the projections, great, we celebrate. It is to the benefit of the people who earn from it. But we don't promise people that you will double your money or it's not a get rich. Investing in real estate, I think that's what I'm trying to say. It's not a get rich quick uh, scheme. It's a scheme. It's a process, or it's deals based on time and consistency and incremental growth. But in the end, it offers decent security for wealth and opportunities to grow your wealth. Another thing we also need to consider in terms of, because we've talked about currency devaluation, there's the inflation and managing of other economic risks, is the fact that a long-term view always helps you to manage economic risks. Some of the biggest economic blows countries have had have set back countries. Yes, there is no doubt about that. But there is also the other side of the story, that economic challenges also produce unique new business opportunities. For instance, in Germany, the Mercedes Benz was born within the period when, in the 1920s, the German mark devalued to 2.4 trillion marks to $1. That's round about when the Mercedes Benz was born. I mean, 1 or 2 years after that. So there is this thing about humanity where, when there is creativity, when there is good ideas, when there is fresh thinking, challenges bring better opportunities. And it's the same thing we're doing in Africa. We look at the potential economic risks we face. We don't deny them, but we find solutions to be able to overcome them. For example, in real estate, as the prices of land and services and things have gone up, as there's been more inflation, we've resulted to more and more communal living, gated or closed communities, shared services, shared facilities. That's a way of reducing the unit costs, but without compromising the quality of standards of what we offer to our buyers.